Good day to all. This is the second part of our discussion involving consignment sales. First up is valuation of stock. If there will be or there are any unsold goods on consignment at the end of the accounting period, then the value of such unsold stock will be carried down to the following period. This means that the ending inventory in terms of consignment or consigned goods at the end of a certain accounting period, which is current, will become the beginning balance for the next accounting period. So you can see this on the next slide for the T account, in which the ending balance of year one unsold stocks for the consigned goods will be the beginning balance for year two. In terms of valuation or the amount by which the stocks or ending inventories for consignment will be valued, that will be in terms of the consignor's cost. So this would include the cost of the shipment or the consigned goods costs which are delivered to the consignee, and as well as the directly attributable costs spent by the consignor for the purpose of consignment. In addition, this will include also the expenses reimbursable, which are considered as product costs. For those who are done with cost accounting, you know these. So these costs are basically costs that are related or very related to the product, hence termed as product costs, and they will benefit or could benefit one accounting period to the next. So example of that will be for the directly attributable costs in relation to transportation or freight for the inventories in which such should be added. So please take note that under cost accounting also, they will become, or the costs of such will become expenses or part of cost of goods sold as soon as the goods are sold. So just a review of cost accounting. Next, for consignor's cost, so that will be the total consignor's cost to be multiplied by the units of closing stock or the ending inventory. So this is actually how we do or compute the consignor's cost in terms of the units of closing stock or ending. And we divide that with the total units of goods sent on consignment. So in other words, for example, let's say we have 100 units of goods which are consigned, and there are 40 units which are remaining. So meaning 60, 100 minus 40 is 60 units sold. But then since we're talking about the cost of the ending inventory, so that will be 40 over 100. So that's 40% also. We can make use of that percentage to multiply to the total consignor's cost to get the consignor's cost for the ending inventory. Then if, for example, we also have the cost of goods on consignment for the total, we can further break this down into total consignor's cost as the sum of cost of goods on consignment plus the consignor's expenses, which are again directly attributable to the cost of the product and multiplied to that same percentage as 40% as an example a while ago. Then for the consignee's expenses, we have to exclude marketing expenses because these are actually period costs which would benefit only one accounting period and not to the next. And then they are not directly related to the consignment contract, or they are not related directly to the consigned goods. They are part of the so-called selling expenses, part of operating expenses. So if we are going to multiply that with the same percentage as 40% for the units of closing stock 400 divided by 100 goods or units of goods. Basically, if we say total units of goods, these are the goods which are in good condition after normal loss. So these are saleable products. And then examples here at the bottom for marketing expenses. We have, for example, advertising, the commission, including ordinary and del credere or creder, then salesmen salaries because they are the ones selling the products, also the bad debts or the discounts allowed, delivery charges to customers. So if we are talking about delivery costs from the consignor to the consignee, that will be added as cost of the product, therefore product cost or inventoriable costs, because they're coming from consignor to consignee to facilitate the consignment contract. But then from the consignee to a third party, that is the customer, the delivery charges shall be expensed immediately now. Then selling expenses as well as the distribution. For example, so we have here the T account for consignment, and then we can notice here that we have the goods on consignment, debit, and then we include the directly attributable costs paid, freight, and insurance, as well as port charges, delivery charges, advertising. This has to be expensed later on, not to be included as cost of the product. To the customer delivery charges, such should be expensed as well. Well, they are part of the debit because remember, if we recall the inventory and consignment account, the consignment account would include also debit to expenses. So discount and the commissions are basically not part of the actual product cost. So discounts allowed are contra revenue account. Remember, sales discount. While the commissions are selling expenses or marketing expenses as explained a while ago. So bottom line, we are going to scrutinize each and every item of costs and expenses. For this one, the workings for value of the stock loss. So we have here 10 boxes, for example. So you can notice here that since there are 1,000 goods consigned or delivered, so that's the denominator, and 10 would be the value of the stock loss or the lost units, in other words. And we are going to add the costs which are directly attributable to the stocks or inventories. So stocks which are being discussed here basically are inventory stocks, not the shares or stocks of corporation. I hope that is clear. Then we have here again a review of that for the consignment account. So we can also see here that there is an additional or there are additional items on the credit side for bank claims, which are, of course, deductions to our inventory and consignment account. And then the profit and loss for stock loss, such will be on the credit side. So after allocating 607 minus 300. Now, I need to show this again. So we have the stock loss at 10 boxes, which is assumed here. The 1,000 units cannot be seen here on the T account. So this is given in this next slide. And then should we multiply that by $60? So we actually get 60,000, which is the goods on consignment. And then we can also notice that we added 500 and 200, which are actually the bank freight and insurance, which are the directly attributable costs spent by the consignor. Then we total that 60,700 times 10 over 1,000. So 10 value of the stock loss or the lost units, 10 boxes, equals $607. And that's why on this slide, we can see that we have the bank claim 300, and then the stock loss is equal to 307. This bank claim is also assumed. In addition, we have here the value of the closing stock. So consignor's cost, which is again the sum of the cost of shipment and the directly attributable cost, multiplied by 50, which is the ending units assumed, divided by 1,000 units total of goods shipped or units shipped by the consignor to the consignee. And we get 3,035. We can notice for consignee's expenses, we have 700 and 1,280, in which these are also directly attributable costs, which are reimbursable on the part of the consignee to be deducted from the net proceeds, the sales of 94,000. And then these are the only two costs out of these costs and expenses, which are to be added to cost of inventory, because the rest are marketing expenses, which are operating expenses or period costs. So that's why the total cost of the closing stock or the units in the ending inventory will be 3,135. Then to continue with our illustration, so we can compute then overall that the profit and loss or profit or loss for this particular consignment contract is 27,642, which is the balancing figure. But basically, if we are going to analyze, we can form this into a so-called profit or loss or income statement format, in which that is the difference between sales minus the cost of consignment sales. We can attach the word consignment to sales. Consignment sales less cost of consignment sales equals gross profit on consignment sales less the operating expenses equals the profit and loss, which should be this particular amount. So we can also make use of that particular formula. So which one should be used? We can make use of this one or that one. As for me, I am more into the income statement format or profit or loss statement format. So that is also allowed, by the way. Then to continue with our illustration, double rule for final amounts to be balanced. Here will be the account on the part of the consignee. So this is the consignee's account in the books of the consignor. And we will get the net remittance or proceeds together with the account sales report of 84,600. It's there for a while. Here, the bank. Then consignee's books, as what we've said, the consignee will be collecting any sales proceeds, then deducting there the reimbursable expenses as well as the commission. The consignee will prepare a consignor account, which is normally a payable account. So meaning to say this is a liability which should be maintained to record the money due to or due from the consignor. So normally it's a due to because we think that the net proceeds would be positive, or this means that sales would exceed any expenses for marketing, for the delivery charges, as well as the commission, than to become a due from the consignor. So in other words, this happens when the consignee makes an excess remittance, which is seldom to occur or happen. Then the procedures, if ever we receive goods from the consignor as consignee, then we just make a memorandum entry. No journal entry, but a memorandum entry. How is that made? We would be writing received 10,000 units of certain type of goods. We will write there the description which are or which would be needed for us to identify that particular product or goods consigned or goods delivered to us. Then second would be expenses paid by the consignor. So no entry on our end because these are recorded in the books of the consignor and these were paid by the consignor. Number three, in case of commission that is received out of the sales, whether ordinary or del credere or on account, so that would be a certain deduction to the consignor's account. So a debit because that is a deduction to the liability, and we will credit commission income in that case. Or if we pay reimbursable expenses or expenses which are done related to the consignment contract on behalf of the consignor, so would also be debiting the consignor account because that will be a deduction, and then we pay, of course, cash for that. Then it's having a net effect then because we will just have to deduct an equivalent amount to our proceeds. Number five, discounts allowed to customers. So that would be debited to the consignor account. And then we are going to credit the name of whoever the debtor or the buyer is, if that is maintained actually. So normally that is also done in terms of consignment sales. So although we can make use of sales discounts account if we would like to. So just for us to be relieved by that. Although because this is credit, so we would suggest that sales discount, if not used, then we will be debiting consignor's account and then we will be crediting the name of the debtor. If we are going to use sales discount, so sales discount will be debited crediting accounts receivable, and then that will be closed later on to the consignor receivable account. So we will debit the consignor receivable and we're going to credit sales discount. So in other words, it will be offsetted. So we will just be using number five. Number six, bad debts borne by the consignor. So a deduction to the consignor also, because these are now the portion of the sales or receivable that cannot be collected. Number 7, if bad debts are borne by the consignee personally, for example, for a DEL credit or an account commission, so we should bear all losses from bad debts. Therefore, that will be an expense on the part of the consignor and crediting the debtor account. Cash sales as well as credit sales, so the difference is on the debit. Cash would involve cash in bank or cash in hand, and then credit the consignor account. So in addition to the liability, credit sales also, but then we are going to debit the receivable account of the debtor. So accounts receivable or consignor. Credit, of course. Then we can also notice here that if there is sales discount, we can also credit here as a credit accounts receivable for the debtor instead of the name. Then payment to the consignor by check or bill. So we are going to debit the consignor account, so to be deducted for the remittance, and we are going to credit the appropriate payment that we made. So cash in bank, or if that is just a bill, a billing statement in which such will be collected later on by the consignor. Okay, and this is the consignor account. So this is similar to what we have had seen, but just in an opposite direction. So in this case, because this is the consignor account, so a liability, it would be increased by any sales, whether that's cash or on account, and then will be minimized by the expenses, which are reimbursable, as well as the commission, and then all the discounts and the bad debts. Then these are actually, of course, under ordinary commission, especially for bad debts, because if del credere, then that will be having a certain separate treatment, in which in number 7, the loss for that will be borne by the consignee, so not to be reflected here. And then the balancing amount or figure will be the bank or bill payable to the consignor. To close that, then we are going to debit it and credit the appropriate payment. For an example here, so as said, you can notice the same amount, 84,600 here, for the consignor account paid by Chan, the consignee. All other amounts are equal or same. Then, in addition to that, we have to consider the further considerations for consignments and the final accounts, which will be disclosed in the financial statements. So for the consignor's book, the trading and profit and loss account, so meaning the income statement, profit and loss figure. So you can notice that credit side shows sales. And then we have also the difference between sales and our cost of sales or goods sold. So the consignment sales less the cost of consignment sales would be gross profit. And then should we deduct the expenses, including the stock loss of consignment? So that would be equal to the consignment profit. And that will be our net profit here, in which that would equal both sides. Okay, so take note of the legend here. N for figure from normal trading, and then C for figure from consignment. As what we said, consignment is a strategy, in fact, a marketing strategy to increase sales. So that is an addition to the available goods for sale for goods on consignment. And then it is also one item of the gross income. So we can add it as part of the total gross income, gross profit, plus the consignment gross profit or gross profit on consignment sales. For the balance sheet, as extracted under current assets, we can see on the consignor's books the balance of the inventory on consignment, and then there is a debit balance for the consignee account, or the consignee account will have a debit balance if there is still a receivable or there is a collectible that is to be received by the consignor from the consignee in relation to the goods which are already sold. And then credit side would be possible as well if, for example, the consignor received excess remittance, so that will become a liability on the part of the consignor. Okay, what about for consignee's books or books of accounts? For the consignee, we have to take note that Those are goods of the consignor, so such would not form part here later on the balance sheet on the part of the consignee. So that will never be part here. And then what will be part here will be the commission income coming from such consignment, and then the bad debts in relation to del credere or on account commission, not the bad debts from ordinary commission. The bad debts here perhaps is on the separate operations of the consignee because the consignee is another entity. So in other words, the commission income will add to other sources of income of the consignee. Then on the balance sheet, we cannot see the inventory that is part of the consignment. Then going back, we can also see here that we cannot have the reimbursable expenses which are in relation to the consignment as part of expenses here because they are actually expenses in relation to the consignment to be reported by the consignor. So I hope that is also clear. Then consignor account in which the normal balance would be credit. So this happens on the credit side, or this will occur normally if the sales proceeds will be greater than all the expenses applicable. So in that case, the balance will be positive, a payable. However, that will be a debit balance, meaning a receivable if the consignee, made an excess remittance to the consignor. Okay. Also, there is a consignor account, which is a liability if the consignee actually made deficient remittance or only made partial remittance to the consignor. So there is still remaining to be made remittance, which will be part of the liability consignor account on the part of the balance sheet of the consignee, and a receivable consignor account debit side on the part of the consignor. All right. So there are so many things which are to remind ourselves at the end of the discussions involving consignment sales. So thank you very much for listening, guys. Hope you are well. Thank you very much, and God bless us all.